If you own an investment property or you're considering buying one, this conversation could literally put money back in your pocket. Stick around as we dive into strategies, common mistakes, and the key benefits of tax depreciation that every investor should know. Every year, Australian property investors miss out on thousands, sometimes up to tens of thousands of dollars in deductions, simply because they don't understand how tax depreciation works. Today, on the CPO Rentals podcast, I'm joined with JD, our Business Development Manager, and our special guest, Bradley Beer from BMT Tax Depreciation. Bradley is the CEO of BMT, and he is a true specialist in his field. Bradley is here to answer some of the most common questions investors have and to break down exactly how you can maximise returns, reduce taxable income, and avoid leaving money on the table. Bradley, thank you so much for flying in from Sydney to Cairns today. We're so excited to have you here.
Great.
I'm Renee Straguzzi. I'm the Director of CPO Rentals, and I'm going to be your host for today. And let's get started.
So Bradley, as a brand new investor in the market, what is tax depreciation?
Yeah, look, if you're buying an investment property, there's a lot of things to consider on why you buy this one and some numbers to crunch. You want to make money from those properties, and you try to do that through capital growth and through cash flow. Depreciation is one of those things that helps cash flow substantially. And what it is really is we kind of understand, if we probably compare it to a car, we understand a car, we know it depreciates in value. If we use that for business and for work, we get to claim a depreciation against that value or loss of the car. With property, it's very similar. If it's an investment property, even though we're buying it to go up or appreciate in value, the actual things in there, the carpet, the stove, the bricks and mortar, they're wearing out and they're reducing in value, and we're allowed to claim that as a deduction as a property investor, just like you do on your car.
Okay. So why is it important for investors?
It means cash. The average first year deduction out of all the tens of thousands of reports we did last year was about $12,000. So we're talking about a fairly substantial deduction. $12,000 is not pocket change, and that's the average across the new and the old properties. And that just means a deduction it's also a non-cash deduction. You don't pay for it each year, so it makes a pretty big difference when you crunch the cash flow on that property to the cost of owning it and some more cash in your pocket.
Probably end up saving more on tax depreciation than what we charge on the management fees for investors.
At a $12,000 deduction, it would actually be the case. The amount of deduction you get there, or the amount of cash you end up back with, is generally more than the management fees that you cost to actually manage that property for someone.
So Bradley, what is a quantity surveyor and why do they get involved in providing depreciation schedules?
Yeah. People look at me funny, maybe not as much. I've been in this business 27 years. Quantity surveyor, they go, what on earth is one of those? So I've done a building degree or a construction management degree. One of the things we come out with from that, with a bit more work, is a quantity surveyor, which is a specialist in the measurement and costing of buildings. So we don't build things, we get a set of plans, we can count the bricks, measure the concrete, the steel and everything, and we will tell you how much it should cost to build that, how much it may have cost, how much it may cost. So anything about the construction costs of a building or how much concrete you need to order, a quantity surveyor should be able to measure that up and tell you the answer to that. Why do we get involved in depreciation? Because these claims that you make relate to the construction cost of the building. So when you don't have all of the costs or information, which a lot of the time you don't, or even if you do have it, there's if you don't have it, then you need to base it on something, and the quantity surveyor can do that for you, and that tax office will accept it. Even if you do have it, there's a specialist piece in making sure we know how to maximise those deductions and get the most out of that property that we can. So that's why we get involved.
So when you get the quantity surveyor involved in that, do they work on the building cost currently or when it was built?
Great question. It is based on a construction cost at the time it was built.
Okay.
So we sort of estimate it today and work out what it would have cost at the time it was put there, because the rules around what we can claim do start from when the building was actually built.
So doesn't an accountant usually do the tax depreciation?
And it's always the first question, especially.
Can't my accountant?
I've got a good accountant. What do I need someone else to
right.
do my tax stuff for? That's a question that is answered by us every day. And an accountant isn't recognised as that quantity surveyor to estimate the cost firstly. So there's a piece around that compliance. Most of the work we do is actually referred by accountants, because you go and you buy a property, you may not understand what this is. You go to do a tax return, the accountant says you need a quantity surveyor to do this piece. We are that specialist in that costing and will be accepted by that. So there's just that compliance piece. But then there's also, we actually visit the property. We go to the house so we can estimate all these things. The accountant doesn't go to the house to do that, nor does he know how to actually estimate that or be accepted to do that. So we work alongside them. We're a specialist in this piece. Use our reports to help maximise those tax returns and get some more dollars back for the property investors.
Is it worth getting a tax depreciation for all the properties?
Another regular question. People think depreciation, new properties, and when you think back to the car, a new car gets the most depreciation because you pay the most for it. New property does get the most depreciation because it costs the most. Older properties, and a lot of the properties you're dealing with around here in that 10, 20, 30 year age range still have quite substantial deductions available. There's a couple of things you can claim. We talked about carpets and blinds and stoves and bricks and concrete. The bricks and concrete last a long time, so you get to claim them over a fair period of time. So even if it is 20 years old, there's still quite substantial deductions available. The thing we would say is, regardless of the age of the property, don't worry about whether there's deductions, because as the quantity surveyor, we're not going to do a depreciation schedule for you unless there's some deductions there. And we can work that out pretty quickly and easily with a few questions and look at a few photos to say, look, there's going to be enough here. If it is really, really old, you still call and ask the question, because some renovations that someone else may have done in the past, you might get some deductions for. And we will always look at a property, identify what's there, regardless of what the age is. So don't worry about the age. There's still deductions. We'll tell you whether, if I tell you it's too old and there's nothing, then there's probably nothing.
There's probably nothing.
Can you give an indication, let's say if I tell you, Bradley, this is the renovations we're planning on doing, could you be able to give an estimate on the depreciation on that? Because then I could kind of work that into my renovation cost.
Yeah, renovation's great question, JD, because there is working out what the depreciation is after you do a renovation is pretty simple. We can give you an indication of what sort of deductions might be there. But your renovation's a great question, because before you renovate it, you should think about what was already there. You might be throwing away some things that still have some depreciation, if you want to call it, value left. So things that have been depreciating there that you're claiming for, if you throw them away, or we call it scrap them, then whatever value was left could be an instant deduction in that year. So with renovations, it's think about the future, but also think about what's there. Call us before you rip it apart. And a quick example that's quite relevant is your kitchen actually has claims over 40 years. It's not unusual to rip out a 30-year-old kitchen these days, and it's still got 10 years of its life left from a tax perspective. So it's got a quarter of its value still left that could be an instant deduction when you rip it out. So if you're thinking about renovating, your question's awesome. Talk to the quantity surveyor before you do it, because there might be stuff that you can get substantial deductions for right then, instantly in that year, that make a big difference to your cash flow.
Amazing.
We've done some case studies which we can get a hold of pretty easy on. Look, you replace a kitchen because you're looking for, a better property, better valuation, and uplift in value, and also better rental. And the tax is a kicker. that you've got as well potentially to do that. So looking at the case studies on how that works sometimes, when you renovate, you look at the extra return on what you spend, and then if you take some of those tax deductions into consideration, it can work quite well.
Yeah, that's so good. I think we've answered my question about how does depreciation work when renovating.
Oh yes, well JD got in front of you there.
Thank you, JD, for that.
So when should an investor be thinking about property depreciation? I work with a lot of first-time investors, and in the process of, let's say, still the property is settling is when they normally engage with me, and would it be a good idea to get them to get in touch with you even before it's just as soon as it settles? Like, how early in the process should someone approach you?
Look, I think when you're looking at buying a property, I'm a firm believer in that you should crunch your numbers. Like, before I buy an investment property, I'd like to, and I kind of probably do it on the back of an envelope, but we actually built a little app that they can do it on called PropCalc to actually crunch some cash flow numbers to see what, if I bought this property, what would my cash flow look like? Part of that is a depreciation estimate, which you do it a calculator online that we've got, or you can put a number in there that you can talk to us about at the start. So think about it early. You don't need to do anything about it other than use the free tools to get there. And then really after it settles, like, you want to get through settlement, get it all sorted out. Then we need to get access to a property to do it. So after it's settled, or as you come up to the next tax return or June, then talk to us and we go and make sure there's some deductions there, make sure it's worth it, go out and visit it and help those tax returns. You can actually, some people adjust their tax throughout the year rather than a tax return at the end. Your accountant will do that. So rather than making a big tax deduction at the end of the year, there's an opportunity to go, how about my employer takes less tax out of my salary or wages throughout the year? So you take that cash flow on the way through. Property investors often do that. Do or don't, not nothing to do with me, it's an accountant question, but then you will need it earlier, I guess is my point.
I have another question for you. So do you have to, is it ideal for you to have a vacant property, or can it be occupied?
Oh, absolutely. We visit properties, occupied properties all the time. Look, if we don't have to annoy or bother a tenant, that's better. But if they're there, they're there. So we try to, if there is vacancy period, that is good to get in, but we've got to work with what we've got and when it needs to be done. But we have, book it yourself online systems if they want to, or we just call the agent, call the tenant, make a convenient time, and try to bother them as least possible. But we do tens of thousands of these each year, so we've done it plenty of times, and we've done nearly 1 million of them in total. So
Oh my gosh.
over the 27, 28 years that the business has been running. We've done it before.
Done it with you. Okay, Bradley, so what can an investor do if they have been missing out on depreciation deductions? Can they go back and get any missed deductions?
Great question. And as we almost follow on from when to think about it, I think all the time, but that's maybe just me. If you don't pay your tax, right, in this country, eventually the tax office will find you, right? They come and get you.
Yeah.
They try to, and they'll go back in the past and make you pay everything you ever owed, probably, and give you a fine for your naughtiness at the same time. If it's not quite as good the other way, but if you haven't been making deductions that you could have, and with depreciation, that's a regular thing, because after some research, we found that 70 or 80% of property investors are not maximising this deduction properly. So lots of people within the rent rolls that you have, etc., are just leaving money at the tax office. I don't know if I like the way they spend it there, but anyway. If you are missing out on it, you can go back and amend up to 2 tax returns pretty easily. So if you've owned the property for 2 years, and you thought your accountant looked after it, or which they may have, or you thought, well, it's not new, maybe I won't get anything, then you can actually get a depreciation schedule and go, last year I should have claimed $7,000 and I didn't, etc. And you can go back and amend pretty easily 2 tax returns and get some cash back from the tax office.
Really good.
Even if you've owned it for a bit longer than that, like if you've owned it for 5 years. You can't go back 5 like the tax office can, but you can go back the 2. And the one important thing to think about there is, if you're thinking about doing a tax return pretty soon, maybe don't do another one, because there's 2 you can go and amend. It's always good. Get an idea of what deduction might be there, which you can do on the calculator or talk to us. And if there's any opportunity, and talk to your accountant, we're accountants are our friends, about what we think, and they'll know what a depreciation quantity surveyor is. And if there's any opportunity, go get your money back from the tax office.
So pretty much what you're saying is, if someone haven't been using your services or tax depreciation, if they start doing it with you, let's say today, they should be able to claim almost double in 1 year.
If they've owned the property for the previous year, there'd be deductions in that year if they haven't been claiming it, and they'll be able to go and you go and actually fix that last tax return. You'd sort of go back to the tax office and say, last year I paid this much tax. Oh, but I forgot my tax deduction of $6,000 because I didn't know about it till today. And you can go back and amend that return, and obviously they'll give you the cash back like they do.
Like instant saving.
That's right.
And that's the one that's there's lots of, there's deductions everywhere, but most of our clients come to us, they do a depreciation schedule, they get a claim next whenever it is. The one that we go for 2 years ago goes, hang on, I did that, and I got like 10 times your fee in cash back, and they're very happy.
Definitely.
They become our advocates.
How can I find out if it's worth my while getting my property depreciated?
The important thing to start with is just ask some questions. We talk to people all day about properties, what their property is, and there's a calculator we've got online that you can go in and put some information about your particular property, and it'll spit you out an approximate estimate of deductions. But you can also just drop us an email or give us a call, and we'll talk through the property. We can see photos of the properties pretty easily because they're rentals and they've been advertised at some point. And we'll talk a few questions through and make sure that there's enough things in there that have been done, or talk about the age of the property and make sure it's worth it. And I guess one important thing to think about there is that we're very careful to make sure that we don't do a depreciation schedule for someone and they don't get some money out of it. We want to identify that in that phone call. And if we're wrong, we put a guarantee on if we have that discussion and we say, yes, it's good, let's go ahead, there's enough deductions here to make it worth going through the exercise and paying some money. We put a guarantee that if we don't get twice that deduction, twice the fee as a deduction in the first full financial year, we'll call you, you can walk away, even if we've already done the inspection on the property, because we should know whether we're going to get enough before we go and spend your money on our time. But we just make sure we worked it out before we go there, and pretty much all the time we do.
So on that, I've got two follow-up questions. One is, do I need to pay that fee up front? And then second question would be, how do I organize it? If I've gone onto the calculator, I've now identified that there is some deduction sitting there. How do I organize it? Yeah,
so from you've identified, you've had a chat to us, then after that, very easily call us and we'll take the detail, or there's every bit of way to do it online instead and fill out the things and just go ready to go ahead and order that. Payment we take either any time from then. We do get started without payment. We just don't release the report until you pay for it, basically. But by then, it's the process is not too long. So we're just somewhere through the process of doing it is when you pay the money before you get it.
The fee that I pay for your services, that's also tax deductible?
Absolutely. Yeah, great question. Tax deductible fee, and the fees, $700 to $800 normally for a depreciation schedule, depending on a couple of things. But so you do make a tax deduction for that amount, and it's as I said earlier, the average deduction that we got from a property was $12,000 in the first full financial year, and this is you don't do it again next year. We project it for the future years. So, even if you get $5,000, you've got your money back straight away, and it continues on basically. So the cost of doing it, and we're very, we do an inspection of the property, which is a very important piece of getting it right, in our opinion. So we're not the cheapest guy to do it necessarily, but we do it thoroughly. In our industry, since COVID, when it was really hard to invest in, to inspect properties. There's a bit more of, we'll just do it from the photos we can see. We don't agree with that. We go to the site, we find everything we can so we can squeeze every dollar out of it. Might cost a little bit more to do that because it cost us more to do that, driving around, going to people's houses and taking a whole bunch of photos. But as far as putting the maximum claim forward to the tax office and then being able to back it with photos and everything on the day, I'm comfortable about that being the most thorough and the most, most deduction result based on that.
So what is involved in preparing a property depreciation schedule?
Simple process. For the person that wants to organise one, we need to collect some details about their property. We need to know who manages it. But in saying that, we need things like how much you paid for it, what was the settlement date, and a lot of the data houses for property information, we can actually get that. So when we get that information, what renovations you've done, a few things, who's your accountant, so we can give them a copy of the report because we like them. And from there, we'll organise the inspection. We talk to the property manager, talk to the tenant, or hopefully it's vacant, that's better. We go through the site, they take the little app, they take some information. It usually takes 20 minutes, 15 minutes, 30 minutes, maybe a bit longer if it's a unit where you get to claim on your common areas as well. We go through those, come back, prepare a depreciation schedule and basically send it to you. Pretty simple.
So on your app or on your website where you got the calculator, you can use any property.
Yeah.
So as an investor, I would think if I'm sitting with two properties where I'm weighing them up, both kind of pretty much offer the same rental returns, cost pretty much the same. It might be good putting in all the information I have on those properties to see and then go for the one that's going to give me the best depreciation, because ultimately I'll be saving money that way, right?
I think if everything else pretty much is eggs for eggs, then the high depreciation gives you better cash flow. I'm a firm believer in buying property that makes money for all of the fundamental reasons it makes money. Even though I'm the depreciation guy, I still have properties that aren't new, that are older, because I buy with the intention to make it something that grows wealth. Depreciation is a cash flow thing that helps with that. But I think if they're eggs for eggs and the same as each other next door, the depreciation is probably the same. Yeah, but if it's very close, then depreciation, cash flow. You can use the calculator and compare the two, but even better, inside the app that does the cash flow overall, you can actually put the rest of the details about the two properties, and inside that PropCalc app, which is free, you can use it, and you can save and compare the properties with each other, and it compares a few other things as well overall.
There's also, is there a list available on your website of what kind of items would normally be qualified for depreciation?
There is, and it's in another app that's called Resi Rates. So the building itself has a claim. I don't think you need something on my website to tell you that it's all the hard stuff, the concrete floors and walls and roof, but there's a list of things that can get claimed quicker. Plant and equipment, we briefly touched on before, the carpets, the hot water services, things that don't last as long. There's a few age restrictions and well, not age, when you bought it restrictions. So there's things around those that you've got to consider. But there is a list of about 170 of those on that app that you can see, and you can see what their life is, but you sort of claim them over, and the rates and things, you can do that. The tax office has got the same list. It's the tax office's list. Yeah. It's just a lot harder to find the website than it is in a little app that's all in front of you.
So display pillows don't make the depreciation list?
They're part of you. If you have, that's a good question, because if you have, you're thinking about this on the way, it's great. The furniture, if you've got, providing it's new when you buy a property, or if you buy it and put it in there, all of your furniture is something that you're using for income producing purposes and therefore depreciable. So your cushions, your lounges, the beds, any furniture that you put in your investment property, it does need to be new, not secondhand. Definitely has claims available, and it's claimable fairly quickly.
Oh, very good.
Yeah, that's very good for, especially like in the city where there's lots of furnished apartments. Fully furnished,
yeah.
Yes, the important thing to consider with furniture, not the rest of the building, furniture and plant, is that Now, since 2017, it needs to be new for you to claim it.
Yeah.
But that, like I say, regardless of the age, call a quantity surveyor, ask the questions. And this is what we ask. Oh, do you have furniture?
Yeah.
Is it new? Is it old? Do you have this? Do you this? How old is it? Someone renovated, new kitchens. We ask those sort of questions when we're identifying what sort of deductions you might get.
Okay, so I've got a different question to ask you. So Bradley, what's the most surprising or unusual item you've ever seen depreciated?
There we go. A few things come to mind.
Yeah.
Garden gnomes.
Oh, really? Brand new?
New garden gnomes. Just in the past, there was a bit of, we read some articles about the garden gnome depreciation, which was interesting, because they're things in your property.
Yeah.
The Melbourne Eye, the Melbourne Eye in Melbourne, where you go right on the Melbourne Eye. We've done a depreciation schedule on that.
Oh, wow.
The big rocking horse in Adelaide. some unusual. The big banana. I think we love big stuff in this country, right?
Yeah.
So the big rocking horse, and just, I don't know, depreciation relates to, well, not just residential properties, commercial properties, and basically anything that's used for income producing purposes, that's building and wider. There's a whole, obviously you photocopy it, for example, but so some interesting stuff over time.
I'm so glad we asked that question.
So Bradley, could you maybe run us through a few examples of properties that you've done depreciation schedules on?
Yeah, and I think we've talked about running a cash flow as you're buying properties and what it could look like. So we've taken something in Cutter's Rise at an approximate purchase price, and I think an easy way to demonstrate that is to let's just run a scenario. I've make some assumptions to do that, and we'll put the numbers on the screen here so we can see what it would look like, with obviously some assumptions that we've made which may not be what you're after, but something, 4-bedroom 2-bathroom house at around the $750,000 purchase price. We've allowed a rent in there of about $725 a week.
Sounds about right.
So that shows an income then for the year of $37,700, as we can see on the screen. There'll be some expenses in order to hold on to that property. Now, we've assumed a certain deposit, we've assumed an interest rate, but let's say those expenses on this are about $40,000, $40,203. A few assumptions in there that you need to consider on your own cash flow. What that means is that this particular property, in order to hold on to it, the owner would have a cost of about $2,500 per year. Not high, about $48 a week. That assumes there's no tax deductions being made. That's simply rent in and money out. Now, if we move to the second page of numbers here, we can see that $2,503 there is an amount that they pay out. What we get to do with our losses on investment properties in Australia is we get to make a deduction for that loss against our other income. So this person would do a tax return, assuming that they are on a 37% marginal tax rate, which we pay different marginal tax rates in Australia. I mean, if it's 48 cents on the dollar, these numbers get better, but at 37%, which is where a lot of investors sit, they would make a tax deduction for that $2,500, and then they would get a tax refund then of $926 at the end of the year. And the cost to own that property now would be $1,577 a year, or about $30 a week. So $48 a week goes back to $30 a week by just making the deduction for your losses. Now, we know that depreciation is important after our conversation today and makes a big difference to the cost of owning this property. And it was fairly inexpensive already at $30 a week based on our assumptions. But what happens is we've looked at this and we can see on the right that we think there's about $17,600 in deductions out of that particular property. That's an estimate of what sort of deductions might be available, but it's a big deduction. Old properties, we don't get $12,000 was the average out of all of them. New properties get more. This one's $17,600. Now, the difference between the $2,500 deduction, which was a loss, is that the depreciation claim at $17,600 is a cash tax deduction. So you don't pay that money out each year. You make a deduction for the wear and tear of the carpets, the bricks and mortar, and all those things. So now we're making a deduction for $20,103. By the way, that whole page of numbers here, my job is the $17,600. That's the bit I do, is come up with that number and make it as much as possible. But with the $20,000 deduction now, our tax refund at the end of the year, once we do that, would be $7,438. So now we've actually ended up with a property that's gone from being a negative cash flow property after we claim depreciation to be a positively geared property. And after tax, you're actually getting $4,900 a year in your pocket when you do this scenario, or about $95 a week positive in cash flow with the tax deduction taken into account, which is great because providing you've got and obviously we've made assumptions there, you deposit and those sorts of things, and everyone needs to calculate this for themselves. Don't act on it as a buy because of that, but this is very real as to what the scenario could look like for lots of investors. And the difference and my part is, the important part of course, is that the depreciation schedule made such a difference, or it made $6,500 a year or $125 a week difference to the cost of, well, it went from cost to after tax profit. The depreciation made such a difference, which is why it's so important.
So important.
And you know, it's much easier to buy one of those than one that costs you money. Each week. Now, back to the fundamentals of buying investment property, in my opinion, again here, if you want it, is that depreciation is the cream at the end, I suppose, and you buy things that are going to make money and do all that sort of stuff. But depreciation makes it a whole lot easier here when it's a newer property, when it's a higher number, because it just makes such a substantial difference. The PropCalc app is a place that, simple as a consumer, you can go and enter in your stuff and enter in what interest rate you think you're going to pay, how much deposit you have, what rent you think you're going to get, and depreciation number will come from the calculator as well. And you can actually crunch these cash flow numbers for yourself. And I think it's very important to do that before you go and buy properties. As a 27 years in this game, talking to property investors and a property investor myself. But the numbers can look pretty good, and obviously it makes a substantial difference.
On behalf of CPO Rentals, JD and myself, I just want to thank you so much, Bradley, for being here with us today. There was so many take-home insights for investors to use. So I just want to thank you very much.
Great to be here. Love talking tax depreciation property all the time.
Thank you, Bradley.
Thank you so much.